Welcome to the Real Estate Show with Pat Lopez, where we talk everything real estate. Today, my guest is Karl Shnitzer from RE/MAX Affiliates and Producers Wealth. Karl, welcome to the show.
Hey, Pat. Happy to be here.
Great. Okay, so this show is going to be a little bit different, a little bit outside of the box, because we're going to talk about life insurance funding real estate projects. So, Karl, before we get into that, and we'll get really into detail how that's possible, tell me your story. How did you get started with RE/MAX and Producers Wealth?
Sure. So prior to everything that I'm doing now, I started in law enforcement. I was a cop for Philadelphia for several years. I worked in the Kensington section and then in Fishtown.
Okay.
And from working there, I saw the amount of construction going on. I mean, in Fishtown, you can't go a block without seeing houses being built.
Right.
And I really saw the amount of money that was flooding the area. And I started to network with some other investors. That kind of led me down the rabbit hole of real estate investing. All of that, once I learned real estate investment, I did my own deals. I did some flips. I did some rental properties. That kind of led into real estate sales because I wanted to represent myself.
Right.
I wanted access to the MLS, everything like that. That all kind of led into, as a real estate investor, you're always looking for more capital. The more capital you have, the more deals you can do. That kind of led in, my research down to life insurance. And at first I wasn't, I kind of saw life insurance and I had the preconceived knowledge that most people have of life insurance that, hey, it's just for a death benefit. And once I kind of really went down that rabbit hole of life insurance, I opened up this whole new, kind of world of how to leverage life insurance to acquire more assets.
Okay. So RE/MAX Affiliates and being a realtor, how long have you been doing that?
So I've been selling real estate since 2019.
Okay.
Yep.
And then with Producers Wealth, how long have you been with them?
I've been a client of Producers Wealth for 6 years. I've been working with the firm for 2 years.
Okay, very good. So we're going to talk about a little bit of real estate, how your business is going.
Sure.
But let's talk about the life insurance
Yeah.
portion of it. How is that possible? Because most people think of term life insurance. There's really no cash value. So explain that.
So life insurance, the products that we sell in order to leverage for other assets, there's a giant gap between how the general population is sold life insurance and how family offices and institutions and very high net worth people are sold life insurance. There's a huge gap there. The general population is sold either term insurance or just straight base insurance with the sole purpose for death benefit.
Right.
So life insurance has two benefits, death benefit and living benefit. When a policy is designed for death benefit, there's little to no cash value. When a policy is designed for living benefit, which of cash value, it's designed differently. So it's less death benefit, but more of the premium dollars that you're putting in are going through a cash value account. Cash value account, real simple, is just one bucket of money. So in life insurance, you have death benefit, you have cash value. Cash value is a savings account that you get through the life insurance carrier. It grows tax-free, it grows guaranteed, and it can be put up as collateral to take loans against it.
Okay. So now there's guaranteed cash value. Oh, my first question is, what kind of rate of returns?
Sure.
What is that?
So cash value, the growth, it has a guaranteed interest rate. Between the different carriers, it's between 3 and 4% guaranteed. On top of the guaranteed interest, they have dividend. A lot of these companies and life insurance companies, and if you go down that, just research topic, life insurance they've been around before the IRS. They've been around before a lot of banks. They consecutively paid a dividend since the mid 1800s.
Right.
So you get the guaranteed interest of 3 to 4% depending on carrier, and then you get dividend on top of it. The cash value growth is normally around 5%, between 4 and 5.
Okay. So then that means the dividends is about 1 or 2%?
Yes.
Okay. So then you combine the guarantee
Yep.
and that. Okay. And then now what is the difference? Because you're saying I can borrow money out. What would be the difference if I have a 401k because I borrowed money out of my 401k? Explain that.
Sure. So a couple differences. One, with a 401k, you're limited to how much money you can actually put in. Life insurance, there's no limit. So that's one difference. Second, when you are borrowing against the asset, 401k has the potential to go down. There is risk to it. It's an investment account. Life insurance, there is no risk. You are paid a guaranteed interest rate. That means your cash value can never suffer a loss. By contract, the life insurance carrier has to pay you that interest rate. So when you are collateralizing that, I don't think it's as risky because there's guaranteed interest. A 401k, God forbid you do take a policy loan and then your account suffers a loss, you could get a margin call on it.
Right.
Another big difference. So 401k, obviously that's a taxable account. Life insurance grows tax free, which is another thing too, because a lot of people look at the 4 to 5% growth and think that's not very attractive. And, that's 4 to 5% tax free, which when you look at, in a taxable account, it's equivalent to, depending on the rate, 7, 8, 9%, depending on a lot of things, fees, taxes, everything.
Right.
The other main difference is life insurance has a death benefit. 401k does not. 401k, if you have $1 million in a 401k, and God forbid something happens, your family may get 6, 7, maybe 800,000 if they're lucky. With a life insurance account, if you have $1 million in your cash value account, your death benefit's a multiple of the cash value. So your family may get 6, 7, 8, $9 million, depending on your age and everything, tax free versus with the same $1 million in an account.
Right. So there's two components. You have your death benefit, you have your cash value. That cash value I can borrow out when I need it. And it could be for anything. If I want to buy a car, if I want to send a kid to college, if I want to buy a house. So anything, where the 401k is limited because I can only take it out for hardship. I can only take it out for school, education, and to buy a house. So I'm limited. With this, I can take it out for anything.
Whatever you want. Yeah. Right. So one of the provisions of your life insurance contract is that you have the right to access a policy loan from the insurance carrier at any time. It's the easiest loan you ever get. There's no credit check. There's no income verification. There's no reason for the loan. Right. And on a loan to value basis, from the insurance carrier, you can access up to 90% of your cash value account. Right. We do have a relationship with a couple other institutions too that allow lines of credit backed by your cash value. Kind of a cool strategy there, because if you have multiple policies, you can get one line of credit secured up to 100% of your cash value across multiple policies. So in the insurance space, it's very common. You see people with 7, 8, 9, 10 policies, and rather than having to take 10 different policy loans, 50,000 from this one, 100 from this one, blah blah blah, you can have one line of credit secured by 10 different policies cash value, and then you're only transacting with the line of credit.
Okay, and then you're saying it's risk free. So what are the insurance companies investing in? I mean, they're not investing in the stock market, right?
So they have very conservative investments in some government bonds and some mortgages and stuff. The policyholders, they generate their dividend and the interest. It's a company, so they're a for-profit company, and they make a lot of money. It's not a nonprofit. The policyholders. So let's kind of take a step back. Within the insurance space, you have stock insurance companies, and then you have mutual insurance companies.
Right.
Stock insurance company trades on the stock exchange. They have policyholders and they have stockholders. So any profit the company makes goes back to stockholders and policyholders. A mutual insurance company is fully owned by the policyholders. So any profit the company makes goes back to the policyholders in the form of a dividend. So a lot of your dividend comes from profit of the insurance company. Insurance company makes profit off of lapsed policies. They make a lot of money off of term insurance. Quick statistic has a 98.89% profit. Basically, only 1.11% of term policies ever pay out. So all those term premiums are profit to the insurance company, and that's where the majority of the dividend comes from. Their insurance companies are experts at analyzing risk,
right?
And they have very, very smart actuaries and the data to support the premium and the death benefit that they pay out.
Right. Okay. Okay, that was pretty interesting. And just full disclosure, I actually have cash value life insurance, and I actually took money out to buy investment properties, and when I turned around and sold them, I just paid my money
That's all
back.
I've ever done,
So I've done that like 3 or 4 times. So when we were speaking, I never really thought about it for a show, but I was like, I actually did that, and I never put 2 and 2 together, saying, hey, let other people know. Okay, so now what are some of the downfalls when it comes to it? Because I know I started when I was 25 years old, and it took a little time to really build up that cash value.
So the main downfall is there is a time period to it. It's not a get rich quick kind of scheme. It's a very long-term approach to building wealth. And the downfall is that you won't have access to 100% of the money that you paid in premium for several years. Normally, the policies that we write takes about 4 years until your annual premium is equivalent to your increase in cash value. So what I mean by that, if your premium's $20,000 per year, By year 4 is when your cash value account will increase by 20,000 or more. So at that point too, there's kind of like a psychological effect to it where it doesn't even feel like you're paying premiums anymore,
Right.
because you're just moving money from checking account to life insurance, and it's there in cash value. So that's, it does take long-term thinking. That's one of the big, everyone asks what the cons are, and that's one of the cons. If you're a short-term thinker and you can't think past, 4, 5, 6 years, then it's probably not, the right vehicle.
Right. So yeah, because in my situation, I was 25, and I think maybe I was in my early 30s before, and then I may have taken out, $30,000, and that ended up being my down payment.
Right.
Be able to get that
Yeah.
into
And just to
into the
clarify
property.
that too, so year 1, you still have access to cash value, probably about 70% of the amount of premium that you pay in, but you won't have access to the full 100 until year 4. So you figure, year 1, if your premium is, 10,000 per year, you may have access to like $7,000. Year 2, another $10,000, you may have like 14, 15,000 in cash value, and that'll slowly grow to year 4 being dollar for dollar. And the main benefit to it, and like you've done and you've experienced yourself, is when you pull a policy loan, you're not technically taking money from your cash value account. You're taking money from the insurance carrier's general fund with your cash value. Essentially, they put a lien on it.
Right.
So
Guaranteed.
yeah, the benefit to that is your cash value is continuously growing and compound even when you're using it. So if you have 100,000 in cash value and you borrow 50,000 to go put down on a flip or something like that, or if you have enough to go buy a flip in cash, your cash value still is going to continue to grow and compound the full 100,000 as if it never left. So what that allows is your money to work in 2 places at once.
Okay. Now, and I know from mine, um, I end up getting charged like 1%.
Mhm.
So let's say the rate of return is 8%, or 7%.
Mhm.
It's 8%. So it's that 1% difference that I'm actually charged for it. But the way I looked at it is, I'm borrowing money at 1%. Where else am I going to get money at 1%?
Right.
Anywhere.
And
But Dale, do you have policies that are like that, or are they different?
yeah, so the main benefit to this whole strategy is that you're gaining uninterrupted compound interest. It's never interrupted by a market loss, so it's going to grow uninterrupted. When you pull a policy loan, you do pay that policy loan back, but you pay it back on an amortized loan or an amortized interest basis. So that allows your money to grow and compound, even at say
Right.
4 or 5%. And even when you're paying interest on a loan at 5%, you're paying interest on a decreased basis because it's amortized interest, and you're growing on a compound basis. So that's, an increased basis. That at the end of the day has a net spread to it. And that's the whole idea of, there's only 3 types of ways that you can spend money, which the first is cash. If you use cash, you lose the opportunity cost of that money.
Right.
And this is something that I was fortunate to learn very young. If you go spend $50,000 cash on a car, that's $50,000 less you have working for you and working for your family and working for your legacy forever.
Right.
If you borrow 50,000, then obviously you're paying 50,000 to a bank or a financial institution. The third way is if you collateralize an asset such as life insurance, borrow from it. Now you're not losing the opportunity cost of that $50,000. You can put 50 in the life insurance, borrow it back out, and now go make the same purchase you were going to do anyway, but you haven't lost the opportunity cost of that money.
Right. Okay. And now we talked about different premiums. So I know when I started, I think I was at $100 a month. So it was like $1,200
Yeah.
a year. I was young,
Yep.
just starting out. And I saw the value. Like I had an illustration showing, hey, by age 65, and back
Mhm.
then I was like, oh my God, it's like 500
Yeah.
years away. I was like, oh, there would be 100,000,
Right.
sitting there. So you can write up, almost any numbers because
Yeah.
you pay,
So you can, there's no minimum to it. Like factually speaking, there's no minimum. There is a minimum recommendation that I would make to somebody, somebody that is only doing 1,200 a year, $100 a month, something like that. You can do that. Totally fine. It is a good, still a good vehicle. I just like to set the expectation that, okay, with this amount of money, the reality of you going out and using it within the next 5 years is very low. I
Right.
mean, you may have $6,000 after 5 years. Now, on the flip side of that, there's a maximum too. 500,000 per year is the maximum that you can put into an insurance policy, and that's more common than you think.
Okay, so in between $1,200, 100 a month to 500,000.
Correct.
That's the gamut.
Yep. Yeah. There's
pretty big spread.
I really like, so when I work with producers wealth, one of the things I really enjoy and I'm really passionate about the families that we work with and the family offices, the amount of money that they position in life insurance is huge. And they have their entire strategies around why they do that, but they're setting up the family legacy, now that I'm a part of, that I
Right.
designed these policies for, that are going to change the entire family legacy for forever.
Right.
And it's really cool when you can see those kind of amounts. And obviously you can imagine the growth of those kinds of policies. And they're good people. We work with awesome people, so they're teaching all their core values to their children that are going to inherit this one day, and they're gonna take those same core values and do great things.
Right. And then the real cool thing is, if anybody, gives you a call and asks you more about it, which we'll get your
Mhm.
contact information shortly, is to see the illustrations.
Yeah.
Illustrations are pretty powerful
Yep.
once you see the compounding and how that works.
Yeah.
Okay, so now let's jump subjects. Real estate.
Sure.
You are active realtor as well, right?
Yep.
Okay.
Yeah.
And you deal with buyers, sellers.
Yeah, I have a really strong niche in the law enforcement community. Obviously, that was my background. So when I left the police department, I started actually selling for other people. Prior to when I was still a cop, I only represented myself and then just friends and family. I didn't take any outside clients.
Right.
When I left the police department and I kind of had more quote unquote free time, I started picking up other clients outside of friends and family. And that's when I really kind of realized that. So cops, are very skeptic people, just in their nature.
Right.
And to work with a realtor, they really feel a lot more comfortable working with somebody that was prior law enforcement.
Right.
And I saw that, they told me that, and I really kind of like, went full force into that. And I started marketing towards cops. My name gets passed around the police department all the time. So a lot of my business, I'd say 80-90% of it is with cops.
Okay, great. Okay, so now if somebody wants to get a hold of you, how do they do that?
So real estate, my website's Homes Around Greater Philadelphia. I'm on all the different social media platforms. Facebook is just Karl Shnitzer. My Instagram is Schnitz93. It was a nickname in high school. And the life insurance, our website's producerswealth.com, or I have a direct scheduling link called schedulewithkarl.com, and that's Karl with a K.
Okay, great. I think it's a really fascinating subject and a little bit different. I thought I'd bring something, a little bit out, outside of the box.
Yeah.
Okay, well, once again, thanks for being here.
Thanks, Pat.
Well, that's the Real Estate Show with Pat Lopez. Be sure to follow the show on Facebook and Instagram, and be sure to subscribe below. I have some great guests, some great content lined up. I don't want you to miss a thing. Also, leave a comment. Tell me some show topics you'd like me to cover in the future. Remember, this show is everything real estate, no limits. Hope you have a great day, and see you soon.